Every single day, hundreds of thousands of retail investors are pining for financial freedom, fire lifestyles, and passive income. What they get most of the time, unfortunately, is almost $1 billion of losses. Why is this? Did they not manifest the gains hard enough? Does the market just not like them? Well, not according to legendary teacher of Warren Buffett, Benjamin Graham himself. In his all-time bestseller, The Intelligent Investor, he outlines very carefully how the bulk of an investor's gains or losses is based on their understanding of how a person's discipline, competitive spirit, fortitude, and character contribute to their investment decisions and the patterns of behavior they need to adopt. This is broken down into 3 essential character categories, which we are going to go through in detail in this video. We'll get to our first character archetype, we are going to call the defensive investor. This is the most misunderstood type of investing because of 2 essential myths. The first one is that as we get older, our investment posture needs to become less and less risky. Putting that right to the test, we can see immediately that an 83-year-old with a large pension, a good amount of savings, grandkids that need to be thought about in 5 to 10 years, has a much wider latitude to accept more risk than a fresh graduate 20 to 25 years old, tens of thousands or even hundreds of thousands of dollars in debt, wanting to save up for a down payment or even a wedding in the next 4 to 5 years. The new graduate cannot afford to lose money whatsoever. And the second myth is that stereotypically defensive investments, such as index funds, mutual funds, and large conservatively financed corporations have a lower overall return than riskier, higher yield investments. It is in fact true that just about 90% of retail traders, who we're just going to define for the purpose of this video as anyone who buys and sells a stock because it has either gone up or down without doing any other research, lose money. Whereas major index funds like the S&P 500, the Dow Jones, or the Russell 2000 have returned very large, outsized gains to almost all their investors who are patient, willing to invest consistently, and are in it for the long haul. And that word patience really brings me nicely into my second point. The defensive investor is someone who explicitly dislikes the study of finance and really the whole hype around investing in general. They do not care what the Dow Jones is doing day to day, and they're way too busy, spending time with their kids to care about what the price of silicon in Mongolia is going to do to the price of Nvidia in 3 to 4 months' time. But they do want some benefit, and charts and research papers have told us this is pretty much exactly what they get. Now, I'm not going to go into too much detail about exactly what the mechanics are of defensive investing, but safe to say they just pick a diversified portfolio of really large index funds and put in the same amount of money every month or on a regular basis and throw in a little bit more as often as they can, and this is called dollar cost averaging. It allows you to take advantage of all the random market price declines and not have to worry too much about when you're going to sell your investments during a bull market, because you're in it for so long, you can wait all that volatility out. In many, if not most cases, this leads to higher overall returns and much lower cortisol levels and stress, which is something we should all learn to see as part of return on investment. And speaking of return on investment, that brings me nicely into my second type of investor for today, who we're going to call the hobbyist investor. For some reason, this person watches CNBC by choice, and yes, it's true, I actually do watch CNBC by choice, and I like reading books about finance, and I'm glued to the news. That being said, my portfolio is still very defensive for the most part because, frankly, I don't have a lot of time to worry. And when I invest in individual companies outside my index funds, they are very large, they are conservatively financed, and they pay big, healthy dividends. If you do a good job at this consistently over a long period of time, it is possible that you'll be able to beat the average market return by a little bit, but it does require significantly more time and energy and worrying about your individual shares than just regular defensive investing. So you'd better make sure if you're going to do that, finance is really something you enjoy as a hobby. And the actual enjoyment of finance brings me into my third type of investor for today, who we're going to call the active investor. This person really likes to watch CNBC, and their favorite thing is researching how stuff happening in one part of the world affects the price of financials in another, and they're really looking to take on finance and investing as either a part-time or maybe even a full-time job. To succeed at this type of investing, you need a lot of free time, a competitive spirit, and you really need to enjoy intellectual, analytical challenges. There are an almost unlimited number of ways to practice active investing, so in his book, Graham spends time talking about a few classic timeless rules. There are 3 of them, and they go like this. First, do not buy either a bond or a stock just because it has a slightly higher dividend payout. After a certain point, marginally higher dividends are very much associated with much higher risk to your principal investment, and that is simply not worth putting at risk, so you can have a little bit more income on a quarterly or even monthly basis. The second rule is do not invest in IPOs categorically. Yes, there are plenty of examples of companies like Apple, Google, and Microsoft that had you invested in them the day they launched on the NASDAQ, you would have collected 10 or even 20 times your money. But what we hear about is very much based in survivor bias. There have been so many more examples of companies that have IPO'd, gotten really hyped, and then tanked a year or even just a couple of months later. And this has caused many investors to simply lose their shirts and have to exit the market entirely. It is not worth it for the average or even the skilled investor. And speaking of skilled investors, the third rule is whatever else you do not.
What was the most you made in a day from day trading?
In a day, I think probably like 40 something thousand.
40,000.
More than 99% of people wind up losing money doing this, and that's tested on people with careers lasting less than 2 years. I'll have a full video coming out later about exactly why day trading is a silly practice, but just remember, for now, the price of a stock at one time is no indicator whatsoever for the price of that same stock at any other time. So at the end of the day, where does that actually leave us? Well, first you have to remember that there is no shame whatsoever in choosing one investment style or another. The key is to know yourself. Know what kind of behavior makes the most sense for you based on your attitude towards finance and how much time you actually want to spend with your investments. You can have a very healthy return using any of these strategies as long as you're consistent and you're disciplined. And when it makes sense, you are willing to pivot from one strategy to another. Active investors, there is no shame in taking a more defensive posture if you feel that your education is no longer up to the task or you just get too busy. Remember, the first rule with all of this is don't lose money. And speaking of not losing, if you liked this video, please feel free to click the subscribe button to show your support for the channel and make sure that you never miss another upload. My name is James Davies, this has been YDFM, and I look forward to seeing you all on the next video. Bye for now.